everyone, welcome back to Invested, where we talk about wealth as being more than just money. Our partners Paul Rand, Joel Rand, and Sarah Minikari will bring in guests and industry thought leaders to chat about meaningful topics on personal finances, health and wellness, ideas for your business, tax planning, and other key issues that impact our lives and our livelihood. So thank you for joining us, and we hope you find our discussions not only practical and educational, but maybe sometimes a little thought-provoking. With that, let's get to the episode.
On today's episode of Invested, I am very excited to speak with Gabe Rissman, co-founder and president of YourStake. YourStake is an analytical and reporting tool for advisors like the Rand Group that helps us analyze various factors of a portfolio in regards to environmental, social, and corporate governance issues, otherwise known as ESG. On today's episode, I speak with Gabe about how to help clients clarify what they would most like to see reflected in their portfolio and making client portfolios match their values and some of the trends in sustainable investing. Prior to founding YourStake, Gabe co-founded Real Impact Tracker, which published an open source methodology for scoring the ESG impact of asset managers. He has also published academic papers on ESG investing and held positions at Rockefeller & Company and the Connecticut Green Bank. Gabe holds a BS in computational astrophysics from Yale, where he also led Yale's fossil fuel development movement and student-managed socially responsible investing fund. So with that, let's get to our interview with Gabe Rissman from YourStake. So hello and welcome back to Invested. Very excited to have Gabe Rissman, co-founder of a software platform, YourStake. Gabe, thanks for joining us.
Thanks so much, Paul. Excited to be here.
Yeah, I appreciate it. So we talked a little bit in the intro about your bio, but if you don't mind, just give us a brief overview of YourStake and what it is and how it's used.
Sure. And I'll start by kind of connecting it with my own story and why we decided to build it as well.
Because I was going to grill you on that right after that. So.
Oh, great. All right. Then I'll give a quick one there and you can ask some follow-up. So my background was as a student climate activist and researcher. So I was really passionate about understanding what actually is able to create impact in sustainable investing. In impact investing. I know that's another one of the questions that I'll be talking about is what do we actually call this stuff? So I had a background working on climate campaigning around finances and working on integrating sustainable investing criteria into investment decisions, looking at the public signaling impact of investors that are really part of a movement on sustainable investing, and trying to understand what are the big challenges that are really keeping it from scale. It's growing really fast, but it's still a small minority of investors that are actually investing in ESG solutions and sustainable investing solutions, even though a huge majority, according to Morgan Stanley, according to a whole bunch of other places, want to align their investments with their values.
Yeah.
So what YourStake does, the simplest way to describe it is, what do you care about? How does your portfolio align with what you care about? How might you be able to better align your investments with what you care about? And we're a tool for financial advisors to be able to help walk their clients through answering those questions in that journey.
Yeah. So in full disclosure, we did start using YourStake. So I don't want anybody I want everybody to know that ahead of time. So, and we've gone through the process. And just talking about the questionnaire. And I did notice there was just a recent update to the questionnaire. Mm-hmm. And I think there's a super interesting story there. So if you wouldn't mind touching on that for a sec, on the development of that and how it works.
Sure. The questionnaire, what we recently released is we worked with a behavioral science research firm called BEworks. And a lot of times when we talk about a behavioral questionnaire with values, people are surprised. They say, well, why do you have to ask a behavioral questionnaire? Why can't I just say I want to invest in climate change or I want to invest in animal welfare?
That's such an easy question, right? Why can't you just put me in the good stuff?
Exactly. Put me in the good stuff. So many times people say, what's the best company for the world?
Yeah, right. Right.
Love that question, right?
Easy question.
And if there was an answer, that would be a different story, right? I think there is an answer. There's a little bit of a tangent. I'm sorry, but there is an answer to which question is, sometimes people say, which question is the most ESG?
Yeah.
Which company is the most ESG? And ESG, environmental, social, and governance factors, ways to evaluate companies. And I think there is an answer to which company is the most ESG. Because the way I think of ESG is the way that oftentimes ESG is used in investment analysis, which is what are the risks to a company of water stress?
Right.
What are the risks to a company of a crazy high CEO pay ratio,
Right.
where the CEO is getting paid way more, reputational risks, morale within the company, whatever it may be? There is an answer to which company has the least amount of risk from environmental and social issues, but which company is the best for the world? Which company is the best company? I mean, that's according to who, right? That some people own guns and some people really are very anti-gun.
Yeah, and that's, I think, for us advisors, and for me particularly, and we've been doing sustainable portfolios for a long time, and other people have come to us and go, okay, well, how do you do it? What do you run? How does it go? And it's a very individual question, right? And so one of the challenges for us is when you sit down with someone and you want to say, okay, do you want to align your values with your portfolio? Well, first, let's talk about what your values are and how do you sort of extract that from a potential client, right? And what's important to you? A, what is important to you? And then B, how important is that to you? And not only how passionate are you about that one cause, but how passionate are you about that relative to other potential things? Because it may be a decision in there, right?
That's totally right. And I really want to get into the trade-offs that exist because they are real and some people shy away from them and other people lean into them. But I'm glad you brought that up. So behavioral questionnaire, yes, there's people care about very different things. It's really important to capture values because there's no one size fits all ESG or sustainability. Yep. And there are kind of two approaches that people have taken. One is we'll just have an open-ended conversation. And that does work. But a lot of times what we've found is advisors don't always ask the right probing questions. And sometimes you miss things. And you don't have a standardized process. And sometimes the clients are shy and they don't share everything. And there are certain things that really matter. And you don't always get that out of a conversation.
Well, so, and having looked at tons and tons of sample questionnaires and different approaches to it and doing the research on it, one of the risks of giving someone a questionnaire is, hey, I'm going to check all the boxes. Yes. Because I don't want to either I think it should be important, right? Or B, I don't want you to know that it's not that important to me. And that again, getting back into that relatively, well, how important is that relative to other things?
That's exactly right. So the one option is not having a tool. Another option is having a check the box tool. And I kid you not, I won't name names, but there was a box to check of, I want to invest in ethical companies. And it's really hard for someone to not check that box and not feel like they're a horrible person, right? Like, and that is obviously an extreme example, but that's what we've seen is a lot of times with these menus, either one, you're not getting enough granularity, or two, it's going to be something that is really hard to not check every box. And a lot of times you don't get everything, or it can be overwhelming because you have 500 things they have to check off and go through. And
one of the examples I use for clients when I'm trying to phrase this for them is, a lot of clients may say, oh, hey, I want, a carbon-free portfolio, or, and you say, okay, well, just so you know, you have a carbon-free portfolio and oil goes up to, I don't know, $120 a barrel where it's at right now. Yep. Your portfolio is going to perform differently. Yep. And then when we start phrasing it in terms of, okay, you don't want, you would prefer not to have an oil and gas company in your portfolio, but what if that oil and gas company has the best safety records of all the oil and gas? Or what if this oil and gas company is making the fastest transition to renewable energies than others? There's so many other sub questions that can go in there.
I mean, and the first thing that came up to my mind, even before you mentioned all that, which is great, is what would you mean by carbon free?
Yeah,
and that you could go. I mean,
don't get me started. Well, we'll talk a little bit about
a million cutoff points there, right?
Right.
Yeah. So when someone says they want a carbon-free portfolio, I'm actually just curious. What do you say? Hold your horses, or what do you do when someone says that?
Well, yes, hold your horses. But again, for us, you have to kind of walk through. All right. Well, where is this person on the education scale of this whole realm of stuff, right? And we could there are a myriad of different side trails we can go off on the conversation, of which I was kind of afraid of. But just talking about carbon offsets and how valid are those carbon offsets, which I know there's a whole bunch of stuff I'm sure you could talk about.
Yeah.
With that, and with a lot of companies today talking about, some of the pledges they've made to be carbon neutral by X date. Well, in many cases, they're counting on being carbon neutral by incorporating technologies that may not even have been invented yet.
Yep.
And we're counting on that. So you gotta, roll up your sleeves and figure out, all right, well, what do you mean by that?
Love that. Yeah. Hold your horses is probably the wrong phrase. It's let's dive in.
Yeah.
Right. Let's explore that. Let's go in. And I love the carbon offsets, and I love the what you're saying about the need to look at these targets and see what they're relying on. Also, a lot of times they're relying on people doing work long after the people setting the targets have left the company. So that's another one that's fun. But now there are more and more short-term targets. There's always skepticism met with, well, people are doing something about it. So I am very encouraged generally by the state of how things are progressing in terms of more and more rigor on holding companies accountable to these commitments.
And I do for sure want to touch on that too. And we're having dealt with this for a while, we're throwing around some terms of ESG, which I think quite a few people are familiar with, right? The environmental, the social, and the governance aspect of that, and even figuring out, well, which one of those very broad categories is most meaningful to you as an individual, right? Are you more concerned about environmental issues? Are you more concerned about the social issues? Mm-hmm. Or are you concerned, like you mentioned, executive compensation, and how does that go into corporate governance, or shareholder advocation, or, all of those things? But that's just ESG. And just talking about ESG, and, there are a lot of terms that are thrown around, including ESG, SRI, and even is SRI socially responsible investing? Is it sustainable and responsible investing? Or are you talking about impact investing and value-based investing? So kind of how do you guys deal with that terminology and sort of parse that out so that you can make it make sense?
That is such a fantastic question. I would say that we are currently in the process of, we used to have ESG as the terminology that we use throughout our website. And I think there's only a couple last traces of ESG on the website, because what we're realizing is the term that we prefer is values-based or values-aligned investing. The reason why is that, well, first, let's start with the SRI and kind of the history of how these terms came up. So socially responsible investing, SRI, that is something that has been around since, I don't know, depending on who you ask, it could be the 1600s, it could be earlier, right. But I think the modern history of where most of what things look like today started in probably the 1960s with the South African apartheid divestment movement, led a lot of times by faith-based religious organizations and some pretty awesome nuns. And they were the beginning of SRI as it's now known, which is a lot of times exclusion-based. We want to avoid investing in companies in apartheid South Africa. It's morphed into, we want to avoid tobacco companies, pornography, alcohol, gambling. So that is oftentimes what SRI meant. And then in probably the 2010s, the term ESG started becoming really popular. And what ESG was, and I kind of previewed this a little bit before, what are all of the factors that we're not looking at as investors? We're looking at, plenty of profitability. We're looking at returns. We're looking at all these different things, but we're not always looking at environmental footprint. We're not always looking at these things that more and more evidence and research is proving that they are risk factors that have impacts on financial performance. So ESG in its purest form, I think, is really what are the risk factors that impact a company that are tied to social and environmental and governance issues.
Yeah, and I think that's another topic that we try and drive home with people that we're talking to is, looking at ESG or looking at sustainability, or however you want to name it or call it, is not necessarily mean, hey, everyone's got to be the tree hugging, Tesla driving, no energy in my portfolio. It's really, hey, what's important to you, and how do we measure that? And then, but using some of those metrics and really getting into that and exposing, hey, if we're not paying attention to it, if you're not paying attention as a corporation, right?
Mhm.
If you're not paying attention to the environment,
Mhm.
if you're not paying attention to the social aspects and supply chains and where are you getting your materials from, if you're not paying attention to corporate governance and, hey, are my shareholders, do they have the rights to vote on the stuff that they should be voting on? You're probably not sustainable. And those companies that aren't paying attention to that stuff are probably at a greater risk.
Mhm.
And those companies that are paying attention to that stuff probably have a potential to outperform.
Yeah.
Right? Now that may take quite a while, right? But those it's a risk reward measurement as well, which kind of begs the question, and in some of the discussion groups, when does sustainable investing just become investing, right? Instead of its own separate, category. But anyway, I got off on a tangent there, and you were talking about.
It's so important, and there's so many resources that are out there, and academic research showing that correlation. And I think it makes logical sense too. And you brought up that really good point. Where are the secular trends going? What are things looking like?
And that you mentioned it being around for such a long time. Hey, the idea of our companies being run well and taking all the risk factors into consideration, that is not a new concept, right? That's been around for a really long time. It's just now some terminology has been thrown around and some different metrics.
True. And with that terminology, I think a lot of people saw ESG and decided to use that term to mean whatever they wanted it to mean. So
right.
That's why we used ESG to start with, is we were like, hey, people looking for something are going to be looking for ESG. And what we realized is we were just contributing to confusion, because sometimes people are using ESG to mean exactly that, risk reduction for the risk factors and looking at opportunities for financial performance in these areas that were not always being considered. But other people, when they say ESG, they mean, I don't want to invest in companies that I think are bad, and I want to invest in companies that I think are good from a moral and ethical standpoint.
Yeah.
And I think other people are thinking about ESG as a way of engaging with companies and using your voice as a shareholder. So there's a lot of ways that people are using the terminology ESG, and it's leading to a lot of confusion. And there's a lot of regulatory and client pushback and demand for clarification.
Yep.
And I am very optimistic that will come and be really positive for the field.
Good.
So the reason why we use the term values-based investing is what we've seen the most demand for, and what most people care about is, this is how I am, this is how I live, this is how I make my purchasing decisions. I also want my investments to reflect my values. So that is oftentimes what people are looking for when they want to use a tool like Your Stake.
Yeah. And so one of the things I wanted to ask you about is, going back to the ESG metrics, and there are a plethora of ways to get data on ESG scores. Lots of companies that are offering, whether it's MSCI or Sustainalytics or, several different others. And they produce both a scoring system. They also produce raw data. And so when we're going through and talking to managers and saying, well, how are you managing it? Sustainable managers, how are you managing this? Where are you getting your data from? Is it your own? Are you doing, but you're not using that data specifically. Can you talk a little bit about the data you use, how you get to it? So you're taking a little bit of a different approach to it.
Sure. So that actually will get a little bit more into my own personal background. I was climate activist plus computational astrophysicist, and
of course
really dove into yeah, well, actually one of the first people that we hired was another computational astrophysicist who also on her spare time, when she wasn't busy doing computational astrophysics, was putting together data visualizations for toxic air pollution in New York City boroughs. So those are the people that we like to hire and bring on the team. So I love Anna so much. And so what we do is it's funny how very similar galaxy formation data sets are to ESG data sets, where there's,
I was just thinking that the other day.
Right? It's the perfect analogy.
I was just trying to figure out how to work that into my discussion of sustainable. Let's talk about galaxy formation.
Well, now you know where to find your next set of clients, is
right,
all the
exactly.
computational astrophysics departments and offer a presentation on ESG and computational galaxy formation.
You have to tie that in for me. I have to figure that out. I mean, you have to explain it to me.
Yeah, so there's a lot of data that's available, but there's a lot of messiness and there's a lot of holes, and there's a lot of basically working with giant data sets that you need to do to be able to put things together, clean it, tie it to the right entity, and make it meaningful as well. That's probably the biggest thing that I think our value add as a company is. There's an advisor that once said, financial advisors can have all the data in the world. It does not help them tell the story of values-based investing. So what we try to do is we pull in all this data from over 100 different sources, plenty of data gaps. We match it all in the right place. And we also try to pull in all of the context and the stories that go with it. So for example, on Your Stake, you'll be able to see the toxic air pollution in your portfolio. You'll be able to get context by comparing it to a benchmark, maybe the S&P 500, whatever it might be. But what we really do and go a lot further is not only will you see the toxic air pollution, but you'll be able to see all of the facilities of the companies that are releasing the toxic air pollution, where they're located, what their main activities are, how much they're releasing, and which toxic chemicals are involved. And we've had people that say, oh my God, I drive home by that factory on my way home from work. And it makes it more understandable to know what's going on. And then furthermore, in addition to the context of here's your toxic air pollution, here's what chemicals there are, we also then do the research and pull in the sources and the literature to convert that amount of toxic air pollution into the equivalent number of asthma attacks, for example. So I should have pulled it up on here, but it's a pretty long chain of how much asthma attacks are caused by toxic air pollution, how much toxic air pollution comes from corporate emissions, what are the different toxicity factors, and where are the population centers, but basically pulling that all together to make it a more meaningful thing. So that's what our general process is. We are taking publicly available data because we always want to have a trace back to the underlying source link. Mm-hmm. We're avoiding voluntary company reporting because greenwashing is a term that we'll get to soon. We want to make sure that we are pulling from trusted sources and trusted reporting, either third parties or mandatory disclosures. And then we're taking all this and making it comparable, pulling it into the system, and then tying it to your portfolio to be able to present all this data.
Wow. Okay. So you have a customized behavior-based questionnaire, and then you pull in this data, and then can you talk just tying the two together?
Sure.
Not that that's an easy question, but
yes, that one. So we have mapped. So yeah, I guess we didn't finish up fully the questionnaire standpoint. So we said what was a problem with existing questionnaires. And when we worked with this behavioral science research firm, what we did was we looked at the academic literature where surveys had been conducted on hundreds of people or thousands in some cases. What are the best questions that relate to someone's moral values? So if you want a high correlation of the answer to someone's questions and their beliefs on a particular issue, those are the types of questions that we pulled into our questionnaire. We also wanted to make them non-judgmental because there is no such thing as a right or wrong answer for these questions. Is what do you care about? And then what we do is based on the way that you answer the questions, we are able to prioritize. These are the issues that matter most. Here are the ones that pass a certain threshold of how much you care. And then we map those issues, those questionnaire questions and responses to particular data points. So for example, if you go out of your way to reduce your environmental footprint and you believe that society should take urgent action to avoid environmental catastrophe, then you might be really interested in your greenhouse gas emissions and your toxic air pollution and your fossil fuel exposure in your portfolio. So we map the responses to the questions to data points and then or issue areas, focus areas, values areas, and then we pull in the data to be able to say, here's what you care about, here's what the data is on the issues that you care about, here's your portfolio so that we can assess your portfolio on the issues that you care about and see what's going on.
Right. Cool. Very cool. And then, I think one of the things I just wanted to touch on are the approaches to portfolio management. So you talk to a client and then we extract, hey, here are the values. Now we have a good idea of this is what's important to me. This is how important that is to me. And now there are different ways of approaching that, right? And so as a portfolio manager, we can use negative screening. We can say, all right, I want to take out the sin stocks, or we can just talk about the impact of divestment and how does that work. So can you just briefly walk us through what are some of the differences between negative screening and divestment and impact investing, and how do you look at those things?
Sure. So I think we already covered ESG and socially responsible investing. There's probably hundreds of other terms and new ones coming out each day. So there's faith-based investing, there's ethical investing, there's impact investing, there's sustainable investing, there's negative screening, there's positive screening. I think the simplest way to categorize it would be in probably smaller buckets. And a lot of times these terms overlap with each other. Mm-hmm. So if you have values and you want to apply those values to your portfolio, one approach is negative screening, like you described. So that is, I don't want to invest in these companies. Let's take them out of my portfolio. So that's one option. Another corollary is positive screening. I'm really passionate about clean energy. I want to invest in these clean energy companies that are producing solar panels or driving the electric vehicle transition or whatever it may be. Now, there's another approach, which is ESG integration, and that can take a couple different forms. So you're talking before about oil and gas companies. What are the best ones for worker safety and which ones are driving the transition to a clean economy? That is one form of ESG integration, is best in class. So we're going to look at all these different sectors. We're going to look at companies, create a diversified portfolio across market caps, across sector, whatever it may be. And we are going to take the best companies in each sector and use those to create our portfolio. And then there are others that might do overweights or underweights based on sector. So, hey, I care about ESG and climate change is my thing. We'll just keep going with that example. Maybe you underweight energy and you overweight other areas that are going to be driving solutions. So it's not always positive inclusion or exclusion. You can change around the weightings and do an integrated approach. And then the last thing is just some investors are taking thematic or using ESG, in this case, I think is the right term, ESG factors to see which companies are best positioned to drive solutions and then actually have really good potential to be able to take advantage of opportunities within environmental, social, and governance. So quick summary, you've got negative screening, get rid of companies, add companies in with positive screening, and then there's a overweight, underweight balancing and analysis, which is ESG integration is probably the encompassing term there.
Yeah, great.
And I probably missed stuff, actually. I'd love to hear if that's how you're thinking about things too.
So yes, all of the above. It's when we talk about, and other advisors will ask, well, how do we approach the whole aspect of it? And one of the things is looking for a tool to help us communicate with the client. What are your values? How important are they? Because most of it, truly, I've never found a questionnaire yet that does that. And we always have questionnaires in our industry. And even for financial planning, and we are a financial planning driven practice, you can't just there are those that do, but in my opinion, you can't just hand somebody a questionnaire and then they fill out the questionnaire and then you get it back and then you put the input in and then you come back with a financial plan. There are just so many questions and follow-up questions and getting into what are the meanings and why is this important to you and why do you want to get there? And I find that the exact same thing when it comes to values-based investing and and I like to use the term sustainable investing for a couple of reasons. One is, there aren't that many non-financial industry people that have heard of ESG. So when you bring up ESG, that doesn't, necessarily ring with them. Sustainability does, right? I think, and most people that are interested in this, that they understand that term of sustainability. And especially when you explain, okay, hey, if we're going for those different silos, and if you don't treat the environment well or people well or your shareholders well, you're probably not sustainable. And they get that. I think that translates well. And then once we get into that, it's a matter of, realistically, we have to walk them through, okay, now that we know what's important to you and how important it is to you and where you may or may not be willing to make some sacrifices, and we get it back into, okay, well, do you want the carbon-free portfolio or what have you? Then you can say, okay, well, based on the assets that you're willing to contribute to
this portfolio, that's going to also determine how we can make that approach, right? Because at certain asset levels, we can't get that finite on certain topics, right? If you have a very large asset level, then that's a little bit easier, right? But and then so the level of assets committed to the strategy is going to also determine how exacting can we get with this, if that makes sense.
It makes a lot of sense. I personally like sustainable investing. I probably use that term without thinking about it, even during this this session just now. That makes a lot of sense.
But and you mentioned greenwashing earlier, and we talked about we were going to talk about that. And I think we've gone through several years now where our industry has been slapping sustainable and ESG and lots of labels on lots of investment strategies and products. And one of our jobs as advisors is to get under the hood with investment managers and figure out, okay, what's your methodology? How are you getting here? How serious are you about this? Are you just taking somebody else's data and just applying this? Are you using negative screening and that's it? Or are you making, what are you incorporating? But, a lot of companies, like I was saying, were worrying more about, from a marketing standpoint, how do we make this look, than they were from a strategy and results standpoint. And so I see that as one of our jobs, but that kind of all falls under the category of what's called greenwashing, which is someone saying we're doing a bunch of stuff and they're not really, or they're not doing it well, or they're not doing what they say they're going to do. And I think from a regulatory standpoint, that's certainly a hot topic right now. And I know you do a lot of research on that and a lot of reading on that, and maybe you can touch on that a little bit.
Yeah, I'd love to. And just as a additional motivator, there were, I think, 4 papers that came out from really big institutions, including Schroders, Capital Group, in 2021. For the entire history of sustainable investing, I'll stick with your term for the rest of this.
Yeah, that's okay.
For the entire history of sustainable investing, the biggest concern for investors was financial performance. Am I going to lose returns? In 2021, that changed. In 2021, the biggest concern among investors was greenwashing and poor data quality. The biggest concern was, are people saying that they're doing this stuff and not actually doing it? So that was really incredible to me to be able to see that. I didn't think it would happen so fast, and it reflected what I've seen. But it's nice to know that it's not just a small silo, that people really care about this stuff.
Yeah.
And they're asking more detailed questions. So I love that you're asking the fund managers that you're trying to work with, what is their methodology and how do they prove what they're doing? Because just looking at a name doesn't do the trick. And that's the easiest thing to do, right? If something's called the Save the World Climate Fund, that looks pretty compelling. Maybe I'll do that. But when you look at it and it doesn't have such a great thing to back it up, that's all too common. So I think that greenwashing can be the most detrimental thing to the whole movement of creating impact through investing, through sustainable investing. And I'm very excited to see a bit of a speed bump where now there's regulatory and client demand of, hey, you're saying all this stuff, now prove it. And unfortunately, we are seeing some examples of greenwashing being real, where there have been recent enforcement actions of fund managers that say that they are applying an ESG score to all of their investments they're evaluating, and that just was not the case when the record keeping was looked at. So a big reason why YourStake was created, I think I mentioned personalization and transparency and explainability. That transparency side, we really want to fight and combat greenwashing. And for us on YourStake, it doesn't matter what the name of the fund is called. It really doesn't matter. We're looking at the actual actions and not the words. And we help advisors and clients to be able to see what's going on there. So I'm really glad to see the attention being paid to greenwashing, how much people care, and more action as a result of this attention, where fund managers and companies are going to have to be better at proving what they're actually doing.
Well, and that's, still yet another side alley we could go down, but just talking about how the strategy of paying attention to this as a risk or reward metric, and how there are managers that have done this for a very long time. There are some very ESG strong or sustainable portfolio managers that have been around for a long time that don't have that in the name of their title, right? In the name of their fund or in their strategy. They haven't put that in there. They've just been doing it for a really long time. And when you look at the methodology and you get in, and like I said, get under the hood, you find out, wow, they've been really looking at this data for a really long time and they're good at it. Mm-hmm. But it's not the green fund or this, or in your example, the Save the World Fund.
Yeah, it's really true. And what we look at, so we're about to release an ESG mandate feature where you can find funds that are saying they're being intentional about this. Yeah. And I always say, take that with a grain of salt, right?
Right.
But one of the other things that we do is we provide information on proxy voting and shareholder engagement. And in our opinion, that is what can give a really good sense of a fund's commitment level to ESG issues. Is if they are focused on gender equality in their investment selection, are they going to support female or women directors?
Yeah.
Are they going to support resolutions calling for diversity improvements? If you're a climate-focused fund, are you going to vote in support of or against setting greenhouse gas reduction targets? And you'd be amazed with the amount of mismatch there. So that's something that we see as a really good. Yeah, well, not you. I guess maybe some of the audience.
No.
They are equally skeptical, and that you wouldn't anymore. That's very true. But that's something I was amazed by a while back, and not anymore. That there's a huge dispersion between the stated goals and the actual resources that are being devoted to these issue areas.
Yeah. And I don't want to keep you all day. I could, and we could go on for this forever, but I do want to talk a little bit about your thoughts on where we are on a regulatory and reporting standpoint. I know there are some cities around the country that have made some changes in their requirements for how their money is allocated and the amount of and the kind of companies that they work with. But just from a sort of a global standpoint, how are we doing in the U.S. as far as this is concerned in requiring companies that I know it's not easy to do, right? And it's not a switch we're going to flip and it's all of a sudden, because it's expensive to collect some of this data and it's not that easy just to start doing it. But where is the U.S. relative to other areas, like how are we doing versus Europe? How are we doing versus Asia? And where do you sort of see all of this going?
That is such a fantastic question. It really is. And I think this is a great time. I'm very lucky. It's a really good time to be a data provider, a data collector, because there's so much new data coming out all the time. And there's really innovative ways to create new things with data. And it's not even coming out with new data, but we are trying to do fun things with the existing data to derive new insights. So for example, if you want to look at the companies in your portfolio and how they're donating to legislators and whether those legislators get good grades or poor grades from the NAACP, that's a new piece of insight that the information was there, and we're combining it together to be able to provide insights about corporate political donations to legislators and how they're ranked on not just NAACP issues, but think of anything. It could really be any political issue, and then you can see how you're aligned. So there is new data being disclosed, but also new ways of combining things all the time to be able to produce new information and new insights and new context. But what's really cool is there are new government sources, mostly in Europe and the US, that I'm familiar with. There is more and more happening in Asia too. Apparently ESG is super hot in Asia. We do know less about that. So I'll speak more about the US and Europe for now. But in the US and Europe, there's more regulatory action that requires companies to disclose particular issues, or at least strategies, or at least some baseline where you can have comparison along mandatory, consistent, comparable data. I don't think that will ever be pushing the frontier. I think it'll be a great baseline. But what is equally exciting to me as the increase in regulatory requirements and the increasing company mandatory disclosure is the increase in nonprofit and academic institutions that are conducting analysis and creating new data points that are more pushing the frontiers of sustainability data. So I think the regulatory is not often going to be pushing frontiers, although it kind of is now a little bit. So maybe I should, but it's mostly going to be what is the baseline least common denominator factors that everyone needs to know. But I love to see more and more institutions coming out and making data publicly available to be able to provide insight and data analysis on companies that can move so much faster than regulatory change.
Awesome. Gabe, I could keep going for a long time, but I know, thank you for, I've used already too much of your time.
I really loved this conversation.
Yeah, it was fun. Again, we'll have to do another one.
I'd be in.
All right, great. Well, thanks for joining us. I appreciate it. Thanks for all your time. And we'll schedule another time to go through this again.
You too. And I'd love to have you on my podcast as well. It should be fun.
Absolutely. We'll do it.
Cool. Thanks.
So that's our episode for today. Thank you for listening. If you found this topic interesting or useful, please let us know. Or if there are other topics you'd like us to address, let us know that too. We'd love to hear from you. Thanks for joining us, and thanks for being invested.
The RAND Group is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA, and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other data information contained in this presentation is provided as general market commentary and does not constitute investment advice. The RAND Group and Hightower Advisors, LLC, or any of its affiliates make no representations or warranties express or implied as to the accuracy or completeness of the information or for the statements or errors or omissions or results obtained from the use of this information. The RAND Group and Hightower Advisors, LLC assume no liability for any action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purposes only. The opinions expressed herein are solely those of the author and do not represent those of Hightower Advisors, LLC, or any of its affiliates.